$8,000 gold may be achieved as early as the second quarter, even assuming at 32 to 1, it would place silver $250. However, setting this higher gold target aside just for a minute, given current massive silver supply shortages only exist due to a lack of enough sellers willing to offer silver for sale at paper prices, with silver now increasingly being priced based upon real supply demand fundamentals, this purely synthetic gold-silver futures ratio will be forced to reset to a physically deliverable spot silver benchmark. To achieve this, liquidity providers estimate a gold-silver ratio closer to 12 to 1, or just based on those parameters, 400 to 458 based just on current conservative LBMA gold price estimates. At 8,000, that would be $660.
The precious metals market is bracing for a massive reset, with gold projected to hit $8,000 as early as the second quarter. This surge is expected to shatter synthetic paper pricing models, forcing a violent revaluation of silver, as acute physical shortages expose the disconnect between supply and suppressed paper prices. Andrew Maguire, a renowned liquidity provider in the wholesale market, breaks down the math behind this imminent shift. He explains that the current shortage is driven by sellers refusing to part with physical metal at artificial rates. This dynamic will force the gold-silver ratio to reset from paper standards to a deliverable benchmark of 12 to 1. Maguire calculates that while a standard ratio implies $250 silver, this physical reset would skyrocket valuations to between $400 and $458 at current levels, or a staggering $660 once gold reaches its $8,000 target. Now, we present the clips from Andrew Maguire's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
With all bullion banks now long for their own books, liquidity providers assess this notional-based percentage algorithm severely undermines asymmetrically imbalanced Western shorts versus longs. Physical silver shortages continue to drive significantly higher lease rates, which due to a lack of supply has forced one-year borrowing costs above 8% at current prices around $90. In fact, 8.5%. And before I exit the charts, let me just illustrate to you how easy $140 silver is. This is where we opened up in 2025. So this is just the length of that bar. Extrapolate that bar and it should be much higher than this. And you exceed $140. You even exceed $155, just for reference. Now, the CME LBMA silver market is simply broken. And with silver prices rapidly forcing physical settlement, liquidity providers estimate the rapidly realignment of the synthetic 32 to 1 April 2011 gold-silver ratio. It's inevitable it will realign. That gap will get closed. Even accepting this purely synthetic paper-to-paper ratio at face value, and given all LBMA bullion banks openly reaffirming spot gold between 4,800 at the lows, 5,500 between 4,800 to 5,500, with most around 5,000 plus. Gold for 2026. Spot silver, based on that ratio alone, will at a minimum have to trade between $150 and $172 bucks based on either of those parameters. And very, very quickly. Now, last January, with gold opening up at 2,614, we targeted 4,500 by the year end. And that is now in alignment with our same well-connected liquidity providers now assessing $8,000 gold as a floor by the end of the fourth quarter 2026. $8,000 gold may be achieved as early as the second quarter, even assuming at 32 to 1, it would place silver at $250. However, setting this higher gold target aside just for a minute, given current massive silver supply shortages only exist due to a lack of enough sellers willing to offer silver for sale at paper prices, with silver now increasingly being priced based upon real supply demand fundamentals, this purely synthetic gold-silver futures ratio will be forced to reset to a physically deliverable spot silver benchmark. To achieve this, liquidity providers estimate a gold-silver ratio closer to 12 to 1, or just based on those parameters, 400 to 458 based just on current conservative LBMA gold price estimates. At 8,000, that would be $660. All at these sustainable supply demand prices, there will be a physically deliverable equilibrium silver price that will appear that will meet supply demand fundamentals. Now, this is important, and this has not been discussed. For the same reason that Basel III gold reclassifications were completely underestimated quite a period of time, here is something about silver that has not yet been realized by the wider market, namely the technicals we alluded to in our earlier, which will drive the silver rally well in excess of our first pit stop at $140, this higher staging point. So for this, we need to look at the same dynamics that drove freshly recategorized first-tier gold from Basel III NSFR compliance on the 1st of January 2023, driving gold $2,900 higher to date alone. That's an increase of 162%. So just looking at that as a comparison. The reason gold has never looked back from this inflection point is because this was the first moment since 1971 where the global facing spot gold foreign exchange market fixed benchmarks had to be physically back. For 50 odd years, they were not. So while FX spot silver, though, is not NSFR compliant, and I'm making this point, there are other reasons, Loco London FX silver will be forced to also be physically back. Now, even in setting aside all the fundamental bullish drivers such as silver export controls, etc., look, spot silver is now being benchmarked in the SGE exchanges, where to offer or to buy silver, it has to be physically owned first and fully paid for. And it is these fundamentals drivers that is evidencing a real supply-demand equilibrium price to emerge that is in absolute conflict with the LPMCL's undeliverable, the cartel's undeliverable fixes. Now, historically, a size buyer in London or Switzerland or anywhere in the West is restricted to how much the cartel would allow you to take delivery of at that fixed price.
The market structure is undergoing a critical inversion as bullion banks flip net long, undermining legacy Western short positions. This shift is being forced by acute physical shortages that have driven one-year lease rates above 8%, signaling a breakdown in the synthetic pricing mechanism. While technical extrapolation points to an immediate target of $140, the longer-term implications of a physical reset are far more explosive. Liquidity providers estimate that the paper-based gold-silver ratio of 32 to 1 is unsustainable and will likely collapse to a physically deliverable 12 to 1. If gold reaches the projected $8,000 floor by late 2026, this realigned ratio implies a silver price of $660 per ounce. This repricing is being accelerated by the Shanghai Gold Exchange, where requirements for fully paid physical metal are exposing the insolvency of the unbacked Western paper fix system, mirroring the impact of Basel III on gold. Let's get back to the interview.
Remember, we've been tracking the Fed's Bank of International Settlements gold lease borrowings, and they've been forcing them month by month by month all through last year to pay back these leases at higher and higher prices. And once again, despite best efforts, they were forced to repay this borrowed gold at a sequentially higher 2025 price, $90 higher than the November close, which was already nosebleed territory for them. So let's have a quick look at the charts. If you recall, that every single month since the Shanghai Futures Exchange opened in March 2024 and all the way up through, and this was the same point on the spot daily chart, every single month without fail, it's forced the Fed to repay billions and billions and billions of dollars of gold back sequentially at higher and higher and higher prices. And because spot gold is NSFR compliant and has to be deliverable, this gold had to be physically bought back at market from under 2,000 at the Shanghai Futures Exchange Open, and it was, I think, just under 2,000, up to the December close here, which was a pushback from breaching above 4,500 into the close here, and that was really basically $2,300 higher after being groomed back to 43.20 to market at the end of a month event, at the end of year event. And by the way, looking at the widening physical to paper disconnect, this month's January mark-to-market event, which will be the end of this bar here, is likely going to force significantly more buying, at least $500 higher than in December. Also, based on extremely reliable first-time liquidity provider feedback, I will expand on why dollar price gold at 4,700 and silver trading in the low 90s is still far too underpriced to bring anywhere near sufficient physical gold and silver to market to meet global physical demand, telegraphing significantly higher prices in both instances. Much as we estimated at the beginning of 2025, 4,500 gold and silver to blow through 50 resistance, which when it did, triggered a very large amount of short covering, and it moved into $80 and on its way to its next higher staging point of $140. Just bring this down a bit so you can see. And that is the next target point. Well, staging point for the next rally, also very similar to what we saw at 80. We will also look at best estimate supply-demand 2026 expectations for the end of year 2026. Now, new percentage-based margin requirements that were instigated yesterday may ultimately require 100% backing for a COMEX position, but not until the Fed repays billions in underwater Office of the Comptroller listed unallocated bets, which are identifiable and there, which are in the SGE's crosshairs every single day, just based upon the effect Basel III has had on FX gold. A similar 162% rise of literally forcing physical backing would price silver at $144, which is very close to our first pit stop equilibrium price of $140. And with CTAs still on the sidelines and having to engage at prices approaching $100 in very short order, silver will have to move into a much higher real supply-demand equilibrium, higher price. That is what we're saying. Alongside the central banks and sovereigns storing and trading inside the global-facing SGE's high-quality liquid asset ecosystem, a large component of the institutional actors that populated the COMEX open interest during the whole of 2025, during that rally, have also now migrated out of gold and silver COMEX futures and the related ETFs into SGE vaults, further misskewing this COMEX-centric 2026 weightings that they attempt to form fit. These same actors have actively been converting these automated 2026 open interest sales into physical. Why? Because they know they were a part of that process and they've exited it and they were anticipating it and have taken advantage of it. And while a lot of this index rebalancing open interest has already been front run, every ounce of the estimated 75 tons of gold open interest forced to be sold has been or is in the process of being converted to physical. We're seeing that. It's happening. And even though that these sales are supposed to end tomorrow, Thursday, look at what's happening. Similarly, every ounce of the $7.7 billion of forced index-related silver futures selling, that's thousands of contracts in supposedly in a 1 week time frame, has in this process been converted into physical. This has been a raid by the physical buyers, by China, by the physical buyers. In summary, really, short-term underpriced COMEX selling has served to constructively rinse out vulnerable speculator froth, good riddance to it, and will continue to be capitalized on by physical buyers converting unallocated, mispriced COMEX open interest into physical. We're undergoing an extremely bullish setup, keying off significantly higher physically underpinned stair steps. Any remaining automated selling into the Thursday 15th deadline, and we've just seen a little bit just now on Wednesday, every single ounce that has been put up, and for all the reasons we've just outlined, are going to be jumped on and very short-lived. Now, a quick look at the charts. The end of December BIS squaring event notably was triggered on the 26th, Boxing Day, the 26th of December, in the thinnest liquidity possible, with London absent on holiday. And this BIS squaring event, although it closed $90 higher than the November level, so basically it was executed into really where liquidity providers had identified these same cartel actors really were going to facilitate. They knew they were going to facilitate the commodity index weighting sales. So they went long. This is exactly what they did. They rinsed out every single speculator, also exactly the same in silver, a $10 rinse of all of the speculators, so indicating this was the equilibrium level where silver simply had to be bought. And so this was all into this index rebalancing. So what we're saying is we saw a huge amount of front running of what was really supposed to happen this week. Essentially front running the known upcoming index reweighting, which actually must be concluded by Thursday. So this is yesterday for you, as this episode will be published on Friday. And we can evidence some last minute sales, and you can bet your life they've been screwing a little bit away to try and discount or put basically gold and silver on offer. But it's just going to be shallow and it's going to get bought. Same in silver futures, which we are seeing here a bit of a pullback after making all-time fresh highs. So what we're saying is, with the largest component of the weighting already front run and the bulk of the froth rinsed out, we will expect any short-term dips to be shallow and extremely buyable.
With the artificial pressure of index rebalancing now removed, the market is entering an extremely bullish setup characterized by shallow dips that are aggressively bought. The massive liquidation of paper contracts has failed to dent the underlying trend, confirming that the physical floor price is rapidly rising. Any short-term pullback is now viewed by liquidity providers not as a correction, but as a fleeting opportunity to accumulate positions before the next leg higher. The continued conversion of open interest into physical delivery signals that the casino of paper trading is losing its influence. Investors are advised to view these brief consolidations as the final boarding call before the market reprices to reflect the actual, unsuppressed value of physical gold and silver. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.